In the first video, we talked about how wealthy families use trusts to control taxes, protect assets, and plan across generations. But that usually leaves people with a bigger question. What kinds of trusts are they actually using? And more importantly, are trusts only for the ultra-wealthy, or can regular families and business owners use them too? To answer that, we need to slow things down and talk about trust types, not in legal language, but in everyday terms. Because trusts aren't mysterious once you understand what they're really doing. Just like an IRA isn't an investment, but a container that tells the IRS how to tax what you put inside of it, a trust is also a container. But instead of telling the IRS how to tax an asset, a trust tells the world who controls it, who benefits from it, and what rules apply. Once you see trusts this way, they start to make a lot more sense. Let's go back to Alex. After learning that ownership determines taxes, Alex's next step wasn't to move everything immediately. His first goal was simply organization. That's where the most common trust comes in, the revocable living trust. A revocable trust is like putting all your important documents into a labeled filing cabinet instead of leaving them scattered across your house. You still own everything. You still control everything. You can open the drawers, move things around, or throw the whole cabinet away if you want. From a tax perspective, nothing changes. Alex still pays the taxes. But from a practical standpoint, everything changes. Assets inside a revocable trust avoid probate, which means when Alex passes away, his family doesn't have to wait months or years for courts to decide how things move. It also keeps things private. Instead of becoming public record, the details stay within the family. This is why revocable trusts are incredibly common for everyday families. They aren't about tax savings. They're about order, simplicity, and reducing stress when something unexpected happens. Now let's shift our attention to when Alex learns about irrevocable trusts. If a revocable trust is like a filing cabinet you control, an irrevocable trust is more like locking something in a safety deposit box and handing the key to someone else. Once assets go in, you don't get to casually take them back. And that loss of control is exactly why they work. Because when Alex no longer owns the asset, the IRS often no longer treats it as part of his taxable estate. That's the trade-off. Less control in exchange for more protection. For families, this can be useful when passing down property, protecting inheritances from lawsuits, or planning for long-term care. For business owners, it can mean separating personal wealth from business risk. The trust becomes the owner, and Alex steps back. Now let's talk about a trust that sounds boring, but quietly does a lot of work. The family trust. A family trust isn't a specific legal category so much as a purpose. It's like setting house rules. Alex might say, "This money can be used for education, healthcare, or starting a business, but not for reckless spending." Instead of handing someone a large check and hoping for the best, the trust releases money gradually, based on rules Alex sets ahead of time. This is incredibly valuable for families who want to help without harming. It's not about control, it's about guidance. Now things get more interesting when taxes enter the conversation again. Alex learns about grantor trusts. This is where the logic flips. In a grantor trust, Alex creates a trust, moves assets into it, but agrees to personally pay the income taxes generated by the trust. That sounds like a bad deal. Why would anyone voluntarily take on someone else's tax bill? But here's the analogy. Imagine Alex owns an apple orchard. Instead of harvesting the apples himself, he gives the orchard to his kids, but he keeps paying for the water. Because he pays the water bill, the orchard keeps producing apples for the kids, untouched. Over time, that unpaid water bill becomes one of the most efficient ways Alex transfers wealth. By paying the taxes, Alex is effectively making tax-free gifts to the trust. This strategy is often used by wealthy families, but the concept matters even if you never use it directly. It teaches an important lesson. Sometimes, paying taxes intentionally can reduce total taxes long-term. Now let's talk about trusts that protect from risk. Asset protection trusts. For business owners, this is where things really click. Running a business is like driving with passengers. Even if you're careful, accidents happen. An asset protection trust is like putting a seatbelt on your personal wealth. If the business gets sued, creditors may not be able to reach assets that are properly held in certain trusts. This isn't about dodging responsibility, it's about separating risk. Just like you wouldn't put your house title in your company's name, you don't want everything exposed to one mistake. This is why doctors, contractors, and entrepreneurs often explore trust planning earlier than people think. Now let's address a common misconception. People hear the word trust and assume it's only useful if you're extremely wealthy. That's not true. For everyday families, trusts are often used to protect children, manage inheritances, plan for special needs, or avoid court involvement. For business owners, trusts are tools for continuity, risk management, and eventual transition. The size of the estate matters less than the complexity of life. Kids, businesses, property, liability. That's when trusts become useful. And here's the most important mindset shift. Trusts aren't about avoiding taxes completely. They're about choosing how and when taxes apply. They're about deciding who owns what, under what rules, and for how long. Just like retirement accounts don't magically make investments better, but instead tell the IRS how to treat them, trusts don't create wealth. They shape it. They give structure to money so it behaves differently. That's why wealthy families use them. Not because they're secret, but because they understand structure. And the biggest takeaway from this entire series is this. You don't need to use every tool. You just need to understand what tools exist so you're not playing the game blind. Trusts aren't just for the wealthy. They're for people who want clarity, protection, and intention around how their money works. If this helped you understand trusts in a way that finally makes sense, subscribe. And if you want part 3 to break down how these ideas scale down to average households, or how business owners combine trusts with retirement accounts, comment what you want to see next.